spending hasn't increased. Also today, there's fallout ahead for bond investors as interest rates rise. So is now the time to sell? Joining me now, advice for your portfolio, Alan Haft, author of You Can Never Be Too Rich. I agree with that. So Alan, these are queasy times for bond investors. What are you telling your clients?
You know, there's definitely storms on the horizon. The big question right now isn't whether or not interest rates are going to go up or not, because they will. Just a question of when. Nobody really knows that answer. However, that being said, there's definitely storms on the horizon. So I'm advising a lot of folks out there to get out of long-term and intermediate-term bonds. And if you're in bond funds, to really consider getting out of bond funds and going to individual bonds. So that
really?
Yeah, because this way, if the value of the bonds go down, at least you know there's a maturity date out there of when you're getting your money back. In a bond fund, if interest rates go up, the values go down, you have no idea when you're getting your money back.
Yeah, well, that's a very good point, and one of the criticisms of bond funds all along. And as you're pointing out, the bond market isn't just one plain vanilla market. There's all kinds of bonds. You like intermediate bonds? Are you saying intermediate corporates? What do you think of treasuries? What about municipals? Where is the value going to lie? And what's going to happen in these individual marketplaces as interest rates start to spike?
Yeah, I mean, it's a real tough go right now in the bond market. The bottom line is, I think that, you know, there's good buys in municipals right now. There's good buys in corporates. You just have to really look for the diamonds in the rough. But I don't like intermediate and long-term bonds. That's why I just want to clarify that.
Sure.
I just think that what people should really be looking at is, if you are going to invest in bonds, make sure you have a maturity date. And a lot of people get scared of that because they think, well, then I have to go out of the bond fund world where a money manager is doing it for me, and I have to try to find those bonds by myself, which is pretty tough. But there are some new places in the world that a lot of people aren't aware of. There's exchange-traded funds, and there's also bond mutual funds out there where the bond managers they have to hold the bonds till maturity. So you're getting the diversification of a bond fund, but you're also getting the assurance that the bond manager is going to hold it to maturity. So you're kind of getting the best of both worlds out there.
Great stuff.
And those are the places that I think people should be looking at.
Well, you know, the other interesting thing we've seen in the bond fund arena is that some of these fund managers are buying stocks to look better. So what do you do if you hold one of these bond funds and it's actually full of stocks? Do you sell that now?
Yeah, then I think you really have to look at what your investment time horizon is, because there's generally nothing wrong with having a little bit of stock in your portfolio if you have a long ways to go before you need that money. But if you're investing in a bond fund because you believe that the investment is safe, like a bond fund typically has historically been, and you see some stocks sprinkled in there, then you should get out of Dodge as fast as you can and get out of those and go into a pure bond fund.
Well, a lot of people out there are saying they plan to cut their bond exposure this year, some 43%. You're essentially recommending the same thing. Get out of some bond funds, certainly, and pick and choose your way. But stand back, Alan, for just a second and tell me, as these rates really start to tick higher, and you've got to think they're going to at some point, what is going to be the broader market impact? What's going to happen to my portfolio?
Oh, gosh, you know, Gerri, it was 30 years ago where we had to worry about this problem. And a lot of people, and the markets were very different than 30 years ago than they are today. I can make a case for the bulls. I can make a case for the bears. It's really, really tough to predict. This is really, truly unprecedented times right now because of a lot of factors that are going on out there. So, you know, again, I think I have to default back to the basics, which is the fundamentals. If you're investing in bonds and you're questioning, should I be there or not? What should I do for the future? What's going to happen to the stock market? What you really have to look at is the fundamentals of your investments. How much time do you have before you need the money? Are you diversified? Are you in the right places? Are you in quality or are you in junk? And once you know the answers to those questions, then you can make some prudent decisions as far as where your money should be at this unprecedented point in time.
But Alan, let me ask you this, because a lot of people out there, a lot of financial advisors, experienced financial advisors, are telling folks to get out of bonds now. That means you're not going to be diversified. Is that good advice?
Again, it depends upon how long you need money for. But if you're creating a lack of diversification, let's suppose I have money in my portfolio and I pull 40% in bonds, I pull it out and I put it into cash. Then the next question is, where do you go with that 40%? And I think at that point in time, to create diversification, you might want to look at some investments, some shorter-term investments that aren't necessarily diversified, but are really paying attention to capital preservation. And there's some interesting alternative investments out there that have just cropped up in the last couple of years in the markets that I think people should look at, like index CDs that are FDIC insured, things that really lend itself towards the capital preservation in case the guess is wrong.
Great stuff, Alan. Thanks for coming on. Good conversation.
Thanks for having me.
Appreciate it.